What's up, Miami? Welcome to another episode of Real Talk 305. I'm your host, Raul Crespo with the Moon Team at Excellence Realty. I'm here at the home office, as you can see today, and we're going to be talking about what does the recession mean about the housing market. All right, guys, let's jump right into it. So I want to talk about some of the fears that I'm hearing from my clients about whether or not this recession is going to have an effect on the housing market. I want to tell you off the bat right now that a recession does not equal a housing market crash or crisis. And I'm going to give you a few key distinctions between what happened now and what happened in 2008, which is what a lot of people are worried is it's going to be a repeat of the late 2000s. You know, is that what we're looking at now? And the fact of the matter is that no, that's not what we're looking at. A couple reasons that 2008 happened were that actually the housing market was the catalyst that brought the economy to its knees. And a couple of reasons for that were easy accesses to mortgage. You could basically walk in and get a mortgage, from somebody just by stated income, and you didn't have to even verify anything. It was extremely easy. Skyrocketing home prices, very unsustainable appreciation. We're going to look at some of that now. There was a surplus of inventory back then, and also excessive equity tapping, meaning that people were taking out loans and credit lines against the value of their homes, and they were over leveraging on their homes. So we're going to dive a little bit deeper into all those things now, which, by the way, none of which are happening today, and I'm going to show you the numbers to back that up. So I'm actually using Zoom as well, so we're going to hop onto that now. Let's do this. Okay, so we're going to start with mortgages. And this right here, what we're looking at is the historical data for the Mortgage Credit Availability Index, which is a metric used by mortgage bankers to basically depict the difficulty or easiness of being able to apply for a mortgage. So basically, the higher the number on the index, the easier it is to get a mortgage, and the lower it is, the more difficult it is. Now, you want there to be some challenge to getting a mortgage because, again, you don't want anybody just to go and get a loan and then over leverage themselves and not be able to afford it, which is what happened in that time. So as we can see here, going into 2006, 7, and 8, this index peaked almost at 900. It basically almost maxed out. And then afterwards, there were some very big restrictions and regulations that got put onto the mortgage market and the mortgage industry, and now that has gone down quite a bit here. So on our next slide, we're going to see what I was telling you about equity, people tapping out on equity loans and everything like that. So that you can see 2005, 6, and 7, there was $824 billion that was being lent out against the equity of people's homes, compared to now in the last 3 years, 232 billion, which is almost a quarter of what it was before. Another interesting statistic that we're not going to see here on the slides is that 37% of homeowners don't even have a mortgage at all. In other words, they own their homes free and clear. And of the other 63%, 1 in every 4 has 50% or more of equity in their home. So that's really, really good. It gives people a lot of wiggle room to be able to play with their finances and be able to get through this difficult time, so that we're not going to see, that wave of foreclosures that everybody's afraid of. This is another interesting thing. So when talking about home affordability, 3 factors are taken into account. Obviously, the price of the home, interest rates, and income. So based on those 3 factors, in 2006, the percent of a median income that was needed to purchase a median price home was 25.4%. So what that basically means is that if I make $4,000, I'm paying $1,000 in my mortgage back then. It's a quarter of what I make goes to my mortgage payment. Today, because of the fact that interest rates have lowered and because of the fact that income has actually increased over these last 12 years, that number is down to only 15.5%. So people are only using a smaller portion of their income to cover their mortgage expense, which is great. Months of inventory for sale. Like I said, one of the driving factors of the 2008 recession was that there was a surplus of inventory, which once you have, it's supply and demand. So if you have too much of something and there's not enough demand to meet the supply, then the prices inevitably go down and they can tumble down into kind of a whirlwind of dropping prices. Combine that with people foreclosing on their homes and it's just a nightmare. So in 2007, there was 8.2 months of inventory, so that you have a reference point. The kind of midline is 6 months. So anything less than 6 months of inventory is considered a seller's market and prices are expected to rise. And anything more than 6 months of inventory is considered a buyer's market and prices are expected to go down. So as you can see here, with 3.1 months, we still have quite a bit of leeway. Even if there is an increase in inventory in the market, that will probably actually alleviate. We have an inventory crisis. I don't want to, not like the crisis that we're going through now, but we've had an issue with inventory for quite a while now, where if you or anybody who's tried to buy a house, especially in the low to mid price point, I mean, houses are on the market for days, not even weeks and months, because of the increased demand in those price points. So actually, if anything, this could make it better for buyers. I'm going to talk a little bit more about when will be a good time to buy throughout this whole situation. I don't like calling it a crisis because I think this is a mental game, and if we stay positive, we can get through this. So I'm just going to call it a situation. Annual home price appreciation. This is another thing that I talked about. Leading up to 2006, 7, and 8, we see there was a very, very hefty growth, 12.5% in 2004, 11.4% in 05. A really important thing that I think you should notice is that the most appreciation we've seen year over year in the last 6 years is still lower than the lowest appreciation in the 6 years leading up to the last crash. So I think that should really tell you that there's been a healthy growth in the market as opposed to this unsustainable sort of, this is what you call a bubble. We have not been in a bubble. We have seen healthy market growth. Okay? So that's another great indicator that this is not like 2008. This is an interesting metric that I didn't know about until I did some of this research. This shows that the home price change in the last 5 recessions has increased in 3 of the 5 and only decreased in one, less than 2%, which was in 1991. So while there have been economic downturns, home values have actually increased in 3 of the 5 last recessions and only decreased by a negligible amount in one of them. Of course, we've got 2008, which, like I said, was led by and caused by the housing crash and the mortgage crash, which is why we saw this massive depreciation. Now, we're not seeing that right now. We're seeing something probably a little bit more like this. Actually, no, more like the dot-com and the 9/11 crash that happened in 2001, where it wasn't that anything was particularly going wrong in the market. It was that external events created a situation that stopped traveling, stopped people from going out, and so on and so forth. And we saw continued appreciation in the years after that. So that's what economists are expecting is going to happen this time, as opposed to 2008. So another key distinction. This is an interesting one that I saw. This is the relation between unemployment rates and the number of home purchases that are happening. So the total number of sales. And they made this graph to kind of demonstrate that, intuition. Intuition would tell you that as unemployment goes up, housing transactions go down. But in the last 3 dips or raises in unemployment, actually home sales have gone up. So in this crash, we saw up to 7.5%. It raised up. But home purchases continue to rise as well. Here in the early 2000s, we also saw an increase in unemployment and an increase in home sales as well. Here we saw a big spike in unemployment. This is in 2008, and the transactions went down, but this was largely due to the fact that up until this point, you can see there's this big spike in the number of home sales. Regulations to the mortgage market had basically gone away, and it was a free-for-all. So of course we saw that dip because those regulations and those restrictions came in and calmed everything down, and did create a dip there in home sales, but that was for the best. That was to kind of heal the market, let's say. And in the last several years, we've seen a consistent decline in unemployment rate, and yet home sales have kind of flattened out at around a 5 million a year mark. So there's about 5 million home sales a year now. So pretty interesting. There's not that correlation with unemployment and home sales that you would imagine would be there. Not at all, actually. This is another aspect of unemployment that I think is important to note. When thinking of unemployment, economists look at the depth of unemployment, in other words, the percentage, and also the length of time that the unemployment is happening. So, of course, we've got the Great Depression over here, which lasted several years. We saw a deep unemployment rate that lasted for the better part of a decade. In the Great Recession, we saw still a very drastic increase in unemployment, almost a 10% here, but it lasted about 4 or 5 years after the big crash, which is still a significant length of time. Now here we are going to see a big spike in unemployment. I think we're at 10% now, and Goldman Sachs is predicting that we're going to go to about 15%. This is a very conservative estimate, meaning that they're estimating on the high end. But they're showing, of course, once these restrictions and regulations and protocols start to get lifted, people are going to go back to work. And we're actually going to talk about it in the next slide, one of the next slides, how quickly that's actually going to happen, according to certain top executives at major companies. So it's going to go down to 6 to 8%, then 5 and 4 in 22 and 23. So here we're going to see that initial hit, and then it's going to dissipate very quickly, which is an awesome sign. We don't want that to lengthen for any long period of time. And of course, these are only estimates, but I think of it in terms of people are afraid, and that people can't physically go and patronize, restaurants or any non-essential places right now. So of course, there's going to be a huge spike in unemployment, but as soon as that gets lifted, those people are going to go right back to work. So that's why we're seeing these numbers dissipate very quickly. So this is the slide that I was telling you about. PricewaterhouseCoopers survey of 50 leaders from a cross-section of industries. If COVID-19 were to end today, how long would you estimate it would take for your company to get back to business as usual? 66% of those leaders said a month or less, and 90% of them said definitely within 1 to 3 months. So that's a pretty quick bounce back given the circumstances once these restrictions and regulations get lifted, for things to get back to business as usual. We know that things are never going to quite be the same. This is something that will forever change the world, but that's still pretty good for us to get back to some level of normalcy. Okay, this is the Goldman Sachs GDP forecast. Okay, now we're going to get into what I was telling you about timing the market and being able to get a good deal at this time, because believe it or not, it's actually a pretty good time to buy, because interest rates are expected to go to the low 3s and for some people even the high 2s, which is pretty wild. It's historically low interest rates. So Goldman Sachs sees a dip in the GDP, a very strong dip in the GDP into Q2, but then they're expecting 12% growth in Q3 and then 10% in Q4, with even stronger growth going into 2021. So don't just take Goldman Sachs' word for it, but here's JP Morgan, Morgan Stanley, and Goldman Sachs together. We're seeing this V shape. The V-type recovery is what a lot of these institutions are saying. And these are financial institutions that manage trillions of dollars for their customers, and they get paid to be right and to be accurate. So it's in their own self-interest to get these numbers correct. And we're seeing them all kind of saying the same thing, which is an excellent indicator that we can expect something like this. Now, of course, at the bottom of this V, as per the previous slide, however long it takes for businesses to get back to normal, that may flatten out a bit and look maybe more like a U shape or something to that effect. But when it comes to timing the market, which, again, I don't think it's a good idea to try to time the market in general, because you just never really know when something's going to turn around or when it's going to dip down. So by being in the market all the time, we are able to take advantage of the market. But anyway, right here, between quarter one and quarter two of this year, we are expected to see some dip in the economy, obviously, as we're seeing now. And the sellers that need to sell during this window of time are going to have to negotiate their prices a little bit more in order to be able to get the deals done because of all the uncertainty and the fact that there's just less buyer demand right now. The main thing that's slowing down the real estate industry in this moment is the lower buyer demand. But that doesn't change the fact that some sellers have to sell. You know, life goes on. People get married, people get divorced, people die, people get jobs, people lose jobs. And so the motivated sellers are going to have to negotiate. And as long as a buyer, you can find that motivated seller, you know, you can find a pretty good deal. I'm not saying you're going to get, you know, half off of a house or anything like that, but you can get yourself into a pretty good situation with a home. So if you've been thinking about buying, you're a little bit nervous, you know, definitely reach out to me, and I'll give you a little bit more information about this, and we can maybe set up a home search, because the truth is that right now is the time to buy if you want to get a deal. So that's about all I've got for you here. Guys, in general, I just want you to try your best not to feed into the headlines, not to feed into the hype, the fear. You know, 24-hour news syndications get paid for you to watch the news. How do they get you to watch the news? By stimulating your emotions. What's the easiest emotion to stimulate? It's your fear. So please don't get bogged down by headlines. Don't get bogged down by fear-mongering. You know, look at the facts, look at the statistics, look at the numbers, and make your own conclusions. I did my best to compile the information for you as succinctly as I can, just so that you know I did get all this information from a company called Keeping Current Matters, which is a fantastic real estate company. They basically compile all the economic statistics around real estate and put them together in a way that is easy to digest, easy to understand. They've got a free blog that you can follow. I'd highly recommend getting into that, because they're constantly, every single day, putting out the best information that you possibly can get on the real estate market. So with that being said, guys, I love you. I wish you all the best. I'm sending you a virtual hug. If there's anything that you may need from me, I'm happy to be of service to you. You know, real estate or not related. If you want me to go do groceries for your grandparents, if you're running out of toilet paper, which I think, thank God, we're over that TP shortage of 2020. Just anything in general. If you just want to talk, if you just want to vent, you know, we're all alone here at our homes, and it can get a little bit crazy. So if there's anything that I can do for you, you know, please reach out to me. My number is 786-360-9413. If you like this video, go ahead and hit that like button, smash the subscribe button if you're watching it on YouTube. And again, I'm here for you. We're in this together. It's not going to be as bad as we are thinking. And have some faith, have some hope. Sending you love. Take care. Bye-bye.